Is the growth story for Nvidia completely over? Is the stock going to come back crashing down? Have margins peaked? Have revenues peaked? Are their products not good enough anymore? Well, unless you are superstitious, then this trading indicator shouldn't worry you. Because remember, a year ago, this was the buy signal. So let's talk about Nvidia, let's talk about Google and Intel, the recent announcement. There has been some weakness with regards to Nvidia stock, but I'll explain why you should not really be that worried. So first up, we have here a Google. So they introduced Google's first ARM-based CPU called Google Axion. So today we are thrilled to announce the latest incarnation of this work, Google Axion processors, our first custom ARM-based CPUs designed for the data center. Axion delivers industry-leading performance and energy efficiency and will be available to Google Cloud customers later this year. Of course, when you read this, you automatically have to link it to Nvidia's business. This means that they're looking for alternatives. They're looking to shift away from relying solely on Nvidia, which of course there is some truth to that. Now they say here Axion processors combine Google's silicon expertise with ARM's highest performing CPU cores to deliver instances with up to 30% better performance and the fastest general purpose ARM-based instances available in the cloud today, up to 50% better performance and up to 60% better energy efficiency than comparable current generation x86 based instances. Now by the way, Google has been making their own custom silicon for quite a while also still being one of Nvidia's largest customers. A comment here from René Haas, the CEO of ARM. They say here that Google's announcement of the new Axion CPU marks a significant milestone in delivering custom silicon that is optimized for Google's infrastructure and built on our high-performance ARM Neoverse V2 platform. Decades of ecosystem investment combined with Google's ongoing innovation and open source software contributions ensure the best experience for the workloads that matter most to customers running on ARM everywhere. We know Nvidia is great with hardware, although it's TSMC that manufactures it, but we know that they've got great hardware, but what's most important there is also the software. It's going to be key for ARM, it's going to be key for Google and for Intel as well. More on that in just a second. They continue by saying here, Google Cloud data centers are already 1.5 times more efficient than the industry average and deliver 3 times more the computing power with the same amount of electrical power compared with 5 years ago. Then moving on to a partnership announcement. Nvidia and Google Cloud collaborate to accelerate AI development. The new collaboration will help startups around the world accelerate the creation of generative AI applications and services. So qualified members of Nvidia's Inception, a global program supporting more than 18,000 startups, will have an accelerated path to using Google Cloud infrastructure with access to Google Cloud credits up to $350,000 for those focused on AI. And lastly, Nvidia's next generation Blackwell platform will come to Google Cloud in early 2025. We've talked about Nvidia's Blackwell during the GTC event. Now, yesterday it was announced that it will be coming to Google Cloud in early 2025. It will also be liquid cooled. So despite all the headlines of probably all the big tech companies trying to rely a bit less on Nvidia, they're all still going to work with Nvidia for the years and years to come. Of course, in the future, in a down cycle, it will be interesting to see what happens. I also have a comment on that later on. If you enjoy this type of videos, leave it a thumbs up, subscribe if you have not, we really appreciate that. If you want to support me even further, do check out the link down in the description and in the pinned comment to get the top 10 best stocks to buy now, or go to fool.com/couchinvestor. Thank you very much. Then we've got Intel that came out with another good announcement, in my opinion. Now, of course, it all remains to be seen how the execution here will be with regards to Gaudi 3. Gaudi 2 was also set to be great, yet in my book, it was a failure. So they unleash enterprise AI with Gaudi 3, AI open system strategy, and new customer wins. So they introduced Intel Gaudi 3 AI accelerator, delivering 50% on average better inference and 40% on average better power efficiency than Nvidia's H100 at a fraction of the cost, which of course is great for the whole ecosystem, is great for all the customers, etc., etc. The more competition, the better it will be, because not everyone has the budget to buy Nvidia's chips, which are expensive, but Like they say here, this is H100, not H200, not Blackwell. Intel also announced the intention to create an open platform for enterprise AI together with SAP, Red Hat, VMware, and other industry leaders to accelerate deployment of secure generative AI systems enabled by retrieval augmented generation. They also say here that with only 10% of enterprises successfully moving Gen AI projects into production last year, Intel's latest offering addressed the challenges business faced in scaling AI initiatives. Just because you have a great project in mind, etc., doesn't always mean you're able to do it. It costs a lot of money, it costs a lot of time. Like I said, the more competition, the more products in the market, the better it will be. If you think things were fast right now, imagine what happens when it's not only Nvidia's products that are available to the masses. Actually, they were not available to the masses, but imagine there were products that were available to the masses. Now we're getting news each and every week of something new coming out. Imagine AMD ramps up, Intel ramps up, you have Nvidia, you now have 3 big players, lots of companies, lots of startups can start using those chips and can start developing new products and services. They also say that Gaudi 3 will be available to original equipment manufacturers or OEM, including Dell, HP, Lenovo, and Supermicro. That would be, I think, in the second quarter of 2024, broadening the AI data center market's offering for enterprises. They also announced a collaboration with Google Cloud, Tails, and Cohesity to leverage Intel's confidential computing capabilities in their cloud instances. Now we know that since Pat came in, the roadmap has been quite long, which, in my opinion, they've achieved what they wanted to achieve. Yes, Gaudi 2 was not really that successful. Now with Gaudi 3, they're making big statements here. Let's see what the adoption rate will be. Again, it's all about execution. Of course, Intel is also heavily focused on being a foundry in the future, number 2 in the world by 2030. It's going to be very, very important to have that aspect of the business, as more and more companies will start to build chips in-house, design them in-house, should I say. And on that, I have a comment here from D.A. Davidson. So major AI chip customers such as Amazon and Microsoft are likely to shift a greater amount of their investment towards in-house hardware and calls for a significant cyclical downturn by 2026. A combination of shrinking AI models, more steady growth in demand, maturing hyperscaler investments, and increased reliance by their largest customers on their own chips don't bode well for Nvidia's out years. Now, we've talked about this already in the past. We know this is a risk, let's say, but all of them are still working with Nvidia. All of them are still buying from Nvidia. Yes, the things that are built in-house are going to be for specific tasks. Maybe in the years to come, that will change, but designing chips, manufacturing chips don't happen overnight. They take a long time. So right now, they're already trying to catch up with Nvidia. And if you're trying to replace Nvidia, well, it will only happen in years and years to come, or actually never, because Nvidia is also moving. They're not saying, okay, 2024 is our peak, we're done, let's see if our clients can come up with something better. No, that's not going to happen. Now, to close this out, a quick review of each and every company we've talked about. First of all, Alphabet, they've done quite well in recent weeks. Thank God I banged the table and talked about that when it was at around $130. In my opinion, still quite cheap. Forward PE only 23.2 times. EV to EBITDA 13.3 times. Price to sales 5.7 times. Price to free cash flow 28.1 times. Yes, these last 3 are now higher than the 5-year mean. Price earnings to growth 1.39 times. I think it's not that expensive. If we look at Intel, yes, it is a bit expensive compared to its 5-year mean. That's because, well, the company is taking a hit because of its huge investments in its foundry business. PE has come down a tiny bit recently, now a forward PE of 28.1 times. It is, let's say, expensive because right now the E for Intel is quite low, but I do expect the earnings to accelerate towards the end of this year. EV to EBITDA 11.8 times, price to sales 2.8 times, free cash flow non-existent right now. Price earnings to growth 1.13, so again, reinforcing what I said with the forward PE. If we look at Nvidia, still cheaper than its 5-year mean on most metrics here. Forward PE 34.3 times, EV to EBITDA 29.1 times, price to sales is the most expensive, 18.8 times, price to free cash flow 77.7 times, and then price earnings to growth under 1, which is very, very special. Again, with the growth rates, the expected growth rates for Nvidia right now, it makes sense, right? This is not expensive. But of course, if there is a sign of weakness in one of the upcoming quarters, then expect the stock market to react accordingly. But currently, really zero signs of that happening. Then lastly here, the most expensive one is ARM, forward PE 94.9 times, EV to EBITDA 75.3 times, price to sales 35.5 times, price to free cash flow 161.1 times, that's in the last 12 months. And then price earnings to growth, yes, it is now way less than before, but still 2.29 times, which can maybe explain why we have here a high PE, and especially when you compare the forward PE of the others plus the price earnings to growth ratio. Okay, you can maybe explain that, but still, this is a company that is expected to grow between 25 to 30% for the coming fiscal years. So yeah, do with that what you want. Of course, these numbers can be revised up as they announce more and more partnerships, as more and more companies start to design their chips based on ARM and not on the x86 ones. Could very well be. But overall, no, I don't think it's completely over for Nvidia. Again, apologies for the clickbait. It's YouTube. They forced me to do it. But hopefully you've got value from this video. If you did, do leave it a thumbs up, subscribe if not, and I'll see you all in the next one. Bye-bye.